Hello, everyone. Welcome to Speak podcast. Today, we're diving deep into something that's really shaped global finance for a long time, American exceptionalism.
Right. This core belief, really, that the U.S. is just inherently different, superior even.
Especially when it comes to the economy and markets, stronger
Precisely.
structure, better performance.
Exactly. And it feeds that idea of the U.S. market being the ultimate safe haven for global money when things get rocky.
And, for quite a while, especially after the 2008 crisis and then again through the pandemic, the data seemed to back that up.
It really did. The U.S. economy didn't just recover, it actually surpassed pre-crisis levels in terms of GDP. That was pretty unique among major economies.
And the stock market performance.
Wow.
U.S. stocks, particularly tech, just soared compared to global peers.
Driven by, strong consumer spending, a job market that just wouldn't quit, and some pretty hefty government spending, think infrastructure, the HIPS Act.
Absolutely. Which has only increased the U.S.'s weight in the global financial system. It's huge now. U.S. equities make up, over half of global market cap?
Easily. A massive concentration.
But, and this is the core of our deep dive today, despite that recent strength, are we starting to see cracks? Are there challenges emerging that question if this dominance can just, continue indefinitely?
That's exactly what we want to unpack, because this idea of exceptionalism, it's not just about recent performance. It has deep historical roots.
Goes way back, right?
Oh, yeah. De Tocqueville in the 1800s talking about America's focus on liberty, individualism, free markets.
Even Lincoln at Gettysburg linking the U.S. to liberty and equality. It's woven into the national identity.
And then post-World War II, the U.S. really solidified that economic and financial leadership.
Bretton Woods in '44 was huge there, setting up the dollar as the world's main reserve currency.
A massive turning point. And U.S. assets, especially treasuries, became seen as the safest things you could possibly own.
And historically, U.S. stocks have delivered, let's be honest, about 6.6% real annual return from 1900 to 2020.
Compared to maybe 4.5% for non-U.S. stocks. A significant gap.
This is important. It hasn't always been that way, right? There have been cycles where international markets led.
Exactly. History shows it's cyclical. That historical outperformance is real, but it doesn't guarantee future outperformance.
Which brings us neatly to the present day, because now we are seeing some potential challenges bubbling up.
Definitely. Several things are kind of converging. U.S. stock valuations look pretty stretched.
Very high, yeah.
Concerns are growing about U.S. government debt, just the sheer scale of it, and its sustainability.
Plus potential policy uncertainty. Tariffs seem like a big one looming.
A very big one. And the interest rate advantage the U.S. had. That gap's narrowing compared to Europe and Japan.
And Europe itself might be looking at a bit of a recovery. Germany's spending plans.
Could be a factor. Plus, you've got tech competition heating up, maybe from China in areas like AI, and just generally more geopolitical risk rattling around.
Okay, lots to unpack there. So our mission today, let's examine the foundations of U.S. economic power, what really drives it.
And we'll look at those emerging cracks.
Yeah.
What are the markets telling us? What are the economic headwinds? What's happening with the dollar and interest rates?
And those policy and geopolitical risks, too. We also want to see, if capital isn't just piling into the U.S. anymore, where might it be going? Europe, China, even gold.
Exactly. And ultimately, what's the future hold for this idea of American exceptionalism in finance? What should we be thinking about?
All right. Let's start with the bedrock. What are those core strengths that have historically powered the U.S. economy?
Well, you have to start with innovation and entrepreneurship. It's almost cliche, but it's true. Silicon Valley is the obvious example, but it goes deeper. Now, AI leadership is key.
What fosters that? Is it the universities, the funding?
It's a mix. Strong universities, yeah. Deep capital markets willing to fund new ideas. Relatively less red tape for starting businesses. Strong IP protection. It all helps.
And the general emphasis on capitalism and free markets. Less government intervention compared to some other places.
That's another pillar. The idea is it promotes competition, efficiency, private sector growth.
Then there's the labor market. It's known for being more flexible, right?
Generally, yes. Easier for companies to hire, fire, adjust to changing conditions compared to, say, parts of Europe. That adaptability helps productivity.
And demographics. The U.S. is younger than many other developed countries.
Relatively speaking, yes. Big millennial and Gen Z cohorts help. Plus, it's historically been good at attracting skilled workers from abroad.
Productivity itself has been a strength too, hasn't it? Output per hour worked.
It has, and actually it seems to have picked up relative to others since the pandemic. especially compared to the EU.
And we can't forget the American consumer. Spending makes up a huge chunk of the economy.
A massive chunk, nearly 70%. Americans tend to spend more, save less, which fuels growth, for better or worse.
Plus, natural resources, energy independence, those provide a solid base.
They do, and strong corporate governance standards, a well-developed investment culture. These things build trust and attract capital.
And U.S. companies are everywhere, operating globally.
Right, expanding their markets, boosting growth potential. All these are, the long-term structural arguments.
But you hinted earlier that maybe these structural factors don't tell the whole story, especially recently.
Exactly. We need to talk about let's call them unconventional policy factors, because they've been huge.
You mean the massive government spending and the Fed's actions?
Precisely. It's sometimes downplayed, but the scale is staggering.
Yeah.
U.S. federal debt has ballooned, from around $7 trillion to $36 trillion in just 2 decades.
Wow. That's a lot.
It means spending, on average, over $1 trillion more each year than taxes brought in. And just in the last year and a half or so, over $5 trillion in stimulus infrastructure, CHIPS Act.
That has to juice the economy.
Unquestionably.
Yeah.
It raises the question, how much of the recent exceptional performance was driven by that level of support? And is that repeatable given the debt levels now?
And then the Fed's side, monetary policy.
Super loose for much of the last 2 decades. Interest rates near zero for long stretches, especially post-GFC and pandemic.
Plus QE, quantitative easing, buying up bonds.
Over $8 trillion worth. That pushed investors out of safe assets and into riskier ones, like stocks. It pumped up demand, inflated asset prices.
So low rates, lots of liquidity. It encouraged risk-taking.
Absolutely. Helped growth, profits, stock prices. But again, the critical question, is this recent outperformance a sign of inherent superiority, or is it heavily influenced by these unprecedented policies? Policies that might be hard to sustain.
I mean, if your debt goes up 5-fold in 20 years and your central bank is in crisis mode for half that time.
Buying assets directly to boost markets for a third of it? Yeah, calling it purely intrinsic exceptionalism feels like a stretch.
And the U.S. could only really do all that because of the dollar's special role, right? The reserve currency status.
Absolutely crucial. The dollar being the main currency held in reserves globally, around 60%, historically gives the U.S. enormous leverage.
Makes it easier to borrow all that money.
Exactly. Global demand for dollar assets helps finance those deficits. And the dollar and treasuries have been the ultimate safe havens. When things go wrong elsewhere, money floods in.
Plus, the U.S. Treasury market itself is just so huge and liquid.
The biggest in the world. Gives the government borrowing power others can only dream of. It's that exorbitant privilege.
So that status has underpinned a lot of this recent policy space.
It really has. But we're seeing some potential wobbles now. The dollar has weakened recently. There are signs of capital maybe leaving the U.S., and worries about debt sustainability are definitely growing.
What happens if global confidence in the dollar and treasuries starts to fade?
That's the multi-trillion-dollar question. The U.S. could lose some of that unique policy flexibility. That exceptional status could erode.
Okay, so the foundations might have some stress points. Let's turn to those cracks you mentioned. Starting with market signals. What are they telling us?
Well, the first thing that jumps out is just how expensive U.S. stocks look. The S&P 500's price-to-earnings ratio. It's way above historical averages.
How high are we talking?
Currently around 28 times earnings. Historically, it's more like 19 to 22. Even the forward PE is elevated, around 18. And the Shiller-TP ratio is high, too.
And compared to other countries?
Significantly more expensive. U.S. stocks might be, say, 50% pricier than foreign stocks on a PE basis. And history suggests that when you start from such high valuations, future returns tend to be lower.
Right. Paying a premium today means less potential upside tomorrow. You also mentioned concentration risk.
Yeah, the market's gains recently have been really dependent on just a handful of mega-cap tech stocks, the Magnificent Seven.
So the whole market kind of hinges on how they do.
To a large extent, yes. And the U.S. market itself is such a huge part of global indices, like 60% of the MSCI, ACWI. That's a lot of eggs in one basket for global investors.
And can those Magnificent Seven keep up that incredible pace?
That's the worry. Their outperformance might be hard to sustain, and their share of overall S&P 500 earnings growth is already expected to shrink.
So a pricey market leaning heavily on a few winners doesn't sound ideal. What's the mood among big investors? Are they still bullish on the U.S.?
Sentiment seems to have really shifted. The Bank of America Global Fund Manager Survey, a big majority, nearly 3/4, think American exceptionalism has actually peaked,
Wow, that's a big change.
and they're acting on it. We've seen record selling of U.S. equities by these managers in the last couple of months. Their allocation to U.S. stocks is now actually underweight overall.
Driven by what? Those tariff concerns?
That seems to be a major factor, yeah. Tariffs, global instability worries, and interestingly, the most crowded trade among these managers, it's not long U.S. tech anymore, it's long gold.
Gold, okay. And the actual money flows confirm this.
Yeah, fund flow data shows money leaving U.S. equity funds, especially the actively managed ones. The big money is clearly getting more cautious.
And you had a table comparing U.S. PE ratios globally. What was the gist?
It just visually confirms how much more expensive the U.S. is versus Europe, Japan, China, emerging markets. China looks particularly cheap on that metric.
So you put it all together, high valuations, concentration, negative sentiment from the pros.
It creates a fragile setup. It increases the odds of mean reversion.
Meaning U.S. performance might lag behind the rest of the world for a while as things balance out.
Exactly. Investors might start looking for better value and less risk elsewhere.
Okay, market signals flashing yellow, maybe red. What about the broader economic headwinds? You mentioned fiscal sustainability concerns.
That's a big one. The sheer size of the U.S. federal debt, over $36 trillion now, and the rising cost of just paying the interest on that debt.
I heard it might soon exceed defense spending.
That's the projection. And historians like Neil Ferguson have pointed to that kind of crossover as a potential warning sign for great powers. Markets are definitely getting nervous about the government's ability to keep borrowing so much, especially if tariffs push inflation up.
And the lingering effects of all that QE and zero interest rates?
Yeah, the worry is that artificially inflated asset prices. And while the market seems eager for the Fed to cut rates,
The Fed might have to stay higher for longer if inflation stays sticky.
it's a real possibility,
Yeah.
especially if the economy holds up surprisingly well. And that contrasts with potentially more dovish central banks elsewhere, like the ECB in Europe.
Which would narrow those interest rate differentials further.
Exactly, making U.S. assets relatively less attractive from a yield perspective and potentially affecting capital flows.
And inflation itself, still stubborn.
Yeah.
And tariffs could worsen it. How's the overall U.S. growth outlook?
It's softening. Institutions like the IMF have been trimming U.S. growth forecasts, explicitly citing the trade war impact. The risk of recession goes up significantly if tariffs stick or escalate.
So, questioning the sustainability of recent growth, especially with protectionism rising, maybe even stagflation risk.
Some analysts are starting to whisper the S word, yes. Slow growth plus inflation is a nasty mix.
Okay, so economic clouds gathering. Now, the dollar weakening and those narrowing rate spreads, what's happening with the dollar index?
It's been trending down, hitting multi-year lows. While it's still high historically, the upward momentum seems gone, maybe even peaked.
Why the decline? Fed pivot expectations? Politics?
All of the above, probably. Expectations of Fed cuts, U.S. political uncertainty, trade tensions heating up again, and those signs of capital outflows we mentioned.
And the gap between U.S. Treasury yields and, say, German bonds or Japanese bonds is shrinking. Why does that matter?
That spread is narrowing, yes. Historically, a narrowing U.S.-German spread can foreshadow non-U.S. economies catching up. It's sometimes acted as an early warning for the end of a bull market cycle, maybe leading European equity turns by a year or two.
So the yield advantage the U.S. offered is fading.
It seems to be diminishing, yeah. Even though U.S. rate hikes pulled global yields up, that extra incentive to hold U.S. bonds is getting smaller.
And it's weird to see the dollar, treasuries, and U.S. stocks all weakening together, isn't it? Not the usual flight to safety.
Very unusual. Normally, in risk-off times, money rushes into the dollar and treasuries. This suggests investors might be looking at U.S. assets differently now.
Because of those specific U.S. risks we discussed. Debt, policy, valuations.
That seems likely. Investors might be choosing to diversify away from U.S. assets, not seeing them as the automatic safe haven. And the narrowing spreads reduce the appeal of U.S. bonds for foreign buyers, adding pressure on the dollar. It hints at a convergence in global economic outlooks.
And the table you had on spreads basically showed this narrowing trend.
Yeah, it showed that while U.S. yields are still higher, the gap has shrunk quite a bit from its widest points, less incentive for international investors.
Okay, got it. Let's really dig into policy risks now. Tariffs and trade wars seem top of mind.
They really are. The aggressive tariff policies, especially under the Trump administration on steel, aluminum, huge tariffs on Chinese goods, threats on autos, have created major uncertainty.
The goal was supposedly to cut deficits, protect industry.
Right, and pressure trade partners. But the economic consequences have been mostly negative. according to major institutions.
Like the IMF, what did they say?
They predicted significant drags on U.S. and global growth. Some estimates suggested trillions in potential lost global GDP if it escalated further. Tariffs mean higher import costs.
Which can fuel inflation.
Exactly. Plus, they heard exports mess up supply chains. Some studies even put the risk of a U.S. recession very high, like 90%, if tariffs persist, and potentially a big drop in U.S.-China trade.
How have investors reacted specifically to tariff news?
It's been a key driver of that record selling by fund managers. They see the trade war as a major tail risk. Tariff announcements often trigger volatility, sell-offs.
And businesses probably hold back on investment.
Likely, yes. Uncertainty makes it hard to plan big capital expenditures. The whole unpredictable nature of it damages the U.S. image as a stable, reliable market, a core part of that exceptionalism idea.
So trade policy is a clear risk. What about broader geopolitical instability, Ukraine, U.S.-China tensions?
We're definitely in a period of elevated geopolitical risk globally. The war in Ukraine, the delicate U.S.-China relationship, uncertainty around U.S. foreign policy like NATO commitments, it all adds up.
How does that typically hit markets?
Geopolitical shocks can cause sharp asset price drops, increase borrowing costs for governments, especially in emerging markets. We've seen market volatility spike. The VIX index hit highs not seen since 2023.
And investors seek safety, like that move to gold you mentioned.
Exactly. Geopolitical risk is a big driver for flows into safe havens. And right now, gold seems to be winning out over traditional U.S. safe havens for many investors.
And it's all connected: trade, finance, commodities.
Absolutely. Ripples spread through all those channels. And crucially, U.S. policy itself, tariffs, foreign policy shifts, has become a source of geopolitical risk, impacting capital flows and stability.
Okay, so if the U.S. looks less appealing and risks are rising, where is money going instead? It has to flow somewhere.
That is the big question. And we are seeing shifts. It's not a tidal wave everywhere, but some areas are definitely attracting more interest.
Let's start with Europe. I've heard talk of a European revival, or mega.
Yes, make Europe great again. There's buzz around it. A key trigger was Germany approving a huge $500 billion infrastructure and climate fund. They even tweaked their debt brake rule to allow it.
What's the focus of that spending?
Modernizing energy, transport, digital, education, health over the next decade or so. Mohamed El-Erian called it a potential Sputnik moment for Europe, spurring investment in defense, infrastructure, green energy.
And defense spending is up across Europe generally, not just Germany.
Oh, yeah. The war in Ukraine and maybe some doubts about U.S. commitments have really pushed that. Germany's Zeitenwende policy aims for over 2% of GDP on defense, plus a $100 billion special fund. The EU is also looking at joint procurement, maybe joint borrowing for defense.
So significant government-led investment. How's the market reacting? Is money actually moving there?
It seems so. Record inflows into European ETFs in early 2025, like 7 times higher year on year. German ETFs saw huge inflows, doubling assets. And European stocks have generally outperformed the U.S. year to date. Euro Stoxx 50 up maybe 10–12% versus an S&P 500 decline.
Which European sectors are benefiting most?
Banks have done very well, up maybe 25–26%. Industrials too, especially defense companies, up over 30%.
I saw that German tank maker Rheinmetall briefly overtook Ferrari in market value.
That tells you something, doesn't it? Investors paying a premium for companies plugged into these long-term spending trends. Construction, chemicals, materials in Europe are also getting a lift.
And it's not just retail money in ETFs. Big institutions are shifting too.
That's a key point. Large European pension funds are reportedly pulling billions out of U.S. stocks to reinvest in Europe. The FT called it the Great Decoupling. That can be long-term pressure on U.S. markets. Swedish funds also seem to be rotating out of North America towards Europe.
And your fund flow table basically showed this stark contrast. Money out of U.S. into Europe.
Exactly. Record outflows from U.S. equity funds in Q1 2025, record inflows into European ones. Even U.S. investors are buying European ETFs. It looks like a real reallocation is underway.
Very interesting. Okay, what about China? Always complex? Is capital flowing there?
China is tricky. It's a balancing act for investors. You've got potentially attractive low valuations and policy support on one side.
But significant economic challenges and geopolitical risks on the other.
Precisely. Let's start with valuations. Compared to the U.S., Chinese stocks look cheap. P/E ratios around 11–15x versus the U.S. near 26x and below China's own history.
Some big tech names there have fallen a long way despite decent fundamentals.
Right. Baidu, Tencent, JD.com, down significantly from highs, suggesting a valuation discount might be priced in.
And the government is trying to stimulate the economy.
They are. Rate cuts, lower reserve requirements for banks, more government spending, easing property rules in places, policies to support manufacturing and infrastructure. They shifted to a moderately loose monetary stance late last year, first time since the GFC.
Plus things like Made in China 2025 and consumer incentives.
Yeah, pushing tech development
Yeah.
and try to boost consumer spending with trade-in schemes for appliances, cars.
And there was that news about DeepSeek AI, challenging U.S. dominance.
That causes stir. A Chinese AI startup claiming near top-tier performance but with vastly lower training costs and faster speeds suggests China can innovate despite U.S. tech restrictions, especially on chips.
And that boosted Chinese tech stocks recently.
It definitely contributed to a rebound, fueled AI optimism there.
So are investment banks telling clients to buy China now, take profits from the U.S.?
Some are, like Citi. The argument is move from expensive U.S. to undervalued, policy-supported China. There's potential for foreign capital to return, especially if U.S. and Indian markets look too pricey. We saw big inflows into China during that peak tariff scare in April.
But the risks haven't gone away. What are the main worries?
Still plenty. The real estate downturn is deep and ongoing. Local government debt is a serious problem. U.S.-China tensions linger. Domestic demand is weak. Deflationary pressures persist in manufacturing.
And growth is expected to slow down.
Expected to moderate to maybe 4.5% in 2025 from over 5% in 2024. Plus, that recent market rebound was very narrow, mostly AI-related. Traditional sectors lagged, suggesting skepticism about a broad recovery. And there are always questions about policy sustainability.
So China, potential value play, but high risk.
That sums it up. Potential upside from low valuations and policy, especially in tech AI. But big downside risks from macro issues in geopolitics. It's not a slam dunk, requires high conviction and risk tolerance.
Okay, so maybe Europe, cautiously China. What about traditional safe havens? You mentioned gold earlier.
Definitely seeing a resurgence there. Gold prices hitting record highs, approaching $3,500. Big inflows into gold ETFs. And fund managers calling long gold the most crowded trade now, overtaking U.S. tech.
Why the rush to gold? What makes it appealing now?
It ticks a lot of boxes in the current environment. Hedge against inflation, especially potential tariff-driven inflation. Hedge against geopolitical risk, trade wars, conflicts. Hedge against U.S. policy uncertainty, potential dollar weakness.
And it's seen as a neutral, non-sovereign asset.
Exactly. Important when global trade relationships are shifting and there's pressure on fiat currencies like the dollar. Plus, central banks keep buying gold, which supports the price.
Are investors looking at other alternatives too? Real estate, private equity?
Some are, yes. As ways to diversify away from listed stocks and bonds, reduce correlation, maybe lower volatility.
But the surge in gold really tells a story about risk aversion.
It really does. It reflects sharply higher global risk aversion and demand for hedges against all these intertwined policy, economic, and geopolitical risks.
And the fact that it's beating treasuries as the preferred haven is significant.
Hugely significant. When U.S. policy itself is a source of uncertainty and the treasury market is volatile, investors are clearly looking for alternative ways to protect capital. It suggests traditional safe havens aren't automatically seen as safe anymore.
Right. So pulling all this together, looking ahead, what are the strategic takeaways for investors navigating this potentially changing landscape? The future of American exceptionalism seems debatable.
It's a huge debate. Is it ending? Pausing, just evolving. The end pause camp points to high valuations, peaking sentiment, outflows, reliance on stimulus, policy risks, narrowing spreads, the European potential, tech competition.
Suggesting the last decade's U.S. outperformance was maybe an anomaly.
Possibly. And that future returns might lag. But the continuation evolution camp stresses the U.S.'s remaining core strengths. Innovation leadership in AI, quantum computing, strong fundamentals, better current growth than peers, robust labor market, top global companies.
Some analysts are still bullish, right? Suggesting the pessimism is overdone.
Yes, people like Tom Lee at Fundstrat. Goldman Sachs argues U.S. leadership in AI will sustain its edge, even with adjustments.
So what's the likely synthesis? Where are things heading?
The market mood seems to be shifting from automatic U.S. outperformance to more caution, more skepticism. Short-term adjustments in the U.S. market seem likely. Long-term, the U.S. probably stays a leader in key innovation areas like high-tech, but maybe less broad market dominance.
So American exceptionalism might become more specific. Leadership in tech, but more average performance elsewhere. More competition.
That seems plausible. A more multipolar world, with Europe potentially showing more policy-driven strength.
So how should investors adapt their strategies?
Global diversification becomes even more critical, maybe reducing that heavy U.S. overweight. Some suggest aiming for around 40% international equity allocation.
And within international, maybe tilting towards Europe?
Potentially, yes,
Yeah.
especially sectors benefiting from German stimulus and European defense spending, industrials, defense, banks, infrastructure, renewables. Maybe more defensive markets like Switzerland or the UK for lower risk.
China remains a cautious allocation based on risk tolerance.
Exactly. Needs careful assessment of the risks versus potential rewards.
What about asset classes? More gold, alternatives, caution on treasuries.
That seems to be the trend. Gold, precious metals as a hedge. Alternatives like real estate, private equity for diversification, lower volatility, and yes, maybe recognizing treasuries might be more volatile, less of a guaranteed safe haven in some scenarios.
And within the U.S. market, maybe a shift to value, focusing on policy beneficiaries.
Could see rotation to value,
Mm.
and focusing on specific sectors globally, European infrastructure defense, maybe U.S. AI infrastructure providers like power, grid equipment.
And overall, just heighten risk management, watching policy, geopolitics closely.
Absolutely. Flexibility and adaptability are key in this environment.
That makes sense for active investors. But what about the average person saving for retirement in their 401k? This sounds complicated.
It does, but the core principles for long-term savers don't really change that much. Yes, a U.S. market downturn hits 401ks hard because they're often heavily U.S. focused. The biggest risk is panic selling during declines.
Because the best days often happen right after the worst, and market timing is impossible.
Pretty much impossible.
Yeah.
So the advice is maintain a long-term view, stick to your plan. If you're young, downturns are buying opportunities. The main thing is ensure you are diversified. Maybe check your international allocation and increase it moderately if it's very low.
Maybe consider Roth conversions if markets are down.
That could be a smart move. Lower tax bill on the conversion. But mostly, avoid big changes based on headlines or short-term jitters. If you're near or in retirement, naturally you'll have a more conservative mix and manage withdrawals carefully.
So even if institutional money is shifting, the strategy for individuals is still about fundamentals.
Largely, yes. Diversification, low costs, discipline, avoiding emotion. That's still the most reliable path, even if future returns come more from international markets. The key adjustment is just making sure your diversification is truly global.
Okay, that's a really comprehensive look. Let's try to wrap this up. Key takeaways. The pressure on American exceptionalism is real, and the global financial landscape is looking more multipolar.
Definitely. The narrative of automatic, unchallenged U.S. dominance is facing serious questions due to valuations, sentiment shifts, policy risks, competition, and that reliance on potentially unsustainable stimulus.
And we identified some major forces reshaping investing globally.
Right. Policy divergence between countries, geopolitical risk becoming normalized, accelerating tech change like AI, maybe a return to value investing after the QE era, and absolutely the renewed importance of diversification.
So the potential end of American exceptionalism isn't necessarily U.S. decline, but more a shift, a rebalancing.
Exactly. More likely a transition to a more diverse global economic and financial order. New growth drivers might emerge elsewhere, like policy-driven Europe. New tech leaders might pop up outside the U.S. Capital is rebalancing globally.
And for investors, simply betting on the U.S. market might not be enough anymore.
Probably not. Success likely requires more vigilance, data-driven decisions, flexibility, strategic global diversification, understanding opportunities region by region, sector by sector, and actively managing policy and geopolitical risks that seems crucial for navigating this new equilibrium.
And ultimately, a smooth transition depends on global stability.
Very much so. Wise leadership, avoiding major conflicts, that provides the stable backdrop needed for markets to adjust and reorient capital effectively.
Thank you for joining us. See you next time.